Let me ask you something. Have you ever seen the market fall and had no idea why? One day everything is green, the next day everything crashes, and the news just says markets react to global cues. But what does that even mean? Because here's the truth, the market is not random, it's reacting to a few powerful factors, and once you understand them, you stop reacting and start interpreting. In this video, we'll see 10 economic factors that control the market, not in a complicated way, but in a way where you can actually see the chain reaction. Think of it like this. One small change creates a ripple, and that ripple moves the entire market. Let's start with the most powerful factor of all, US Federal Reserve rates. Why does a decision in the US affect your Indian portfolio? The US Federal Reserve plays a major role in global markets. When the Fed raises interest rates, investors shift their money towards the US, where returns are higher and considered safer. This leads to capital outflows from emerging markets like India, putting pressure on stock markets and weakening the rupee. When the Fed cuts rates, the opposite happens. Global liquidity increases, investors look forward for better return elsewhere, and money flows back into markets like India, often leading to market rallies. So, even if nothing changes domestically, global money movement can still impact your investments. RBI interest rates. Why do markets rise when interest rates fall and struggle when they rise again? When the Reserve Bank of India cuts interest rates, borrowing becomes cheaper. Lower interest rates encourage individuals and businesses to take loans for homes, cars, and expansion. This increases spending and investment across the economy. As demand rises, businesses grow, profits improve, and stock markets tend to move higher. At the same time, traditional saving options like fixed deposits become less attractive due to lower returns. Sectors such as banking, automobiles, and real estate benefit the most because their growth depends heavily on borrowing. On the other hand, where the RBI raises interest rates, loans become expensive. Spending slows down, business expansion reduces, and economic activity weakens. This often leads to pressure on stock markets, while fixed deposits return become more attractive. Inflation. Why does rising inflation often create pressure on markets? Inflation refers to a sustained increase in prices across the economy. When inflation rises, the cost of living increases, which reduces consumers' purchasing power. At the same time, central banks often respond by increasing interest rates to control rising prices. This combination, higher costs and higher interest rates, puts pressure on businesses and reduces market valuations. As a result, stock markets and bonds may decline, while assets like gold tend to perform better as investors seek safety and preserve value. Low and stable inflation, however, supports economic growth and is generally positive for markets. GDP growth. What does economic growth really signal for the stock market? GDP measures the overall growth of an economy. When GDP is strong, it indicates that businesses are producing more and people are earning more and consumption is increases. This usually leads to higher corporate earnings, which support stock market growth. However, if GDP growth becomes too high too quickly, it can lead to overheating and inflation, which may trigger interest rate hikes. On the other hand, weak GDP signals slowing economic activity. Businesses earn less, confidence declines, and investors move towards safer assets like bonds or gold. Oil prices. Why can a rise in oil prices affect almost every sector? Oil is one of the most important commodities for economies like India. When oil prices rise, transportation, manufacturing, and logistics costs increase. This pushes overall costs higher across industries and contributes to inflation. Higher inflation then leads to tighter monetary policy and pressure on the stock market. Sectors like airlines, logistics, and manufacturing are particularly affected due to rising input costs, while oil producing companies may benefit from higher prices. So, oil doesn't just affect fuel, it impacts the entire economic system. Rupee versus dollar. However, export oriented sectors like IT and pharmaceuticals benefit because they earn revenue in dollars, which becomes even more valuable when converted to rupees. When the rupee strengthens, imports become cheaper, supporting consumption. but export-driven companies may see reduced earnings. So, currency movements create both winners and losers within the market. FII inflows and outflows. What actually happens when foreign investors move money in or out? Foreign institutional investors or FIIs play a significant role in market movements. When foreign investors bring money into India, it increases liquidity in the market, pushing stock prices higher. When they withdraw money, liquidity reduces and markets can fall sharply. These flows are often influenced by global factors like interest rates, risk sentiment, and economic conditions. That's why markets sometimes move even without major domestic news. Global markets. What do global markets really tell us about the direction our own market might take next? The Indian market is deeply connected to major global exchanges like the New York Stock Exchange, Nasdaq, London Stock Exchange, and markets across Asia. When these markets move, they don't move in isolation. They send signals across the world. If the US markets fall due to interest rate changes or economic concerns, or if the London Stock Exchange reacts to global events, investor sentiment turns cautious everywhere, including India. Money starts flowing out of riskier markets and Indian equities can see pressure. On the other hand, when global markets are strong, when Wall Street is optimistic and Europe is stable, confidence travels across borders, supporting markets like India. Monsoon. How can something like rainfall influence market performance? In India, the monsoon plays a crucial role in the economy. A good monsoon leads to higher agricultural output, increased rural income, and stronger consumption. This benefits sectors like FMCG, tractors, and rural-focused businesses. A poor monsoon can reduce crop output, increase food inflation, and weaken rural demand, negatively impacting these sectors. This is why even weather patterns can influence market movements in India. GST collections. What do GST numbers reveal about the real economy? GST collections provide insight into the health of the formal economy. When GST collections are rising, it indicates strong business activity, higher consumption, and improved compliance. This boosts the market confidence and supports sectors like retail, banking, and consumer goods. It acts as a real-time indicator of economic growth. So, if you zoom out, the market is not random at all. It's reacting to three things: money flow, economic growth, and human emotion. Interest rates and Fed control money. Inflation and oil control costs. GDP shows growth, FIIs move liquidity, global markets show fluctuations. And once you connect these dots, the market starts making sense. Most people chase the market after it moves, but once you understand these signals, you start seeing the move before it happens. And that's where real investing begins. If this changed how you see the market, save this video, because this is not just information, this is your framework.